We're going to move on here to home builders, and those stocks, of course, as our viewers know, hitting new highs. The S&P Home Builders ETF, for example, hitting its first closing record since 2021. This, of course, is Toll Brothers posted a beat on the top and bottom lines. That was this week. Talking about strong demand in the fourth quarter. We talked about it a bit yesterday. Doug Yearley, Toll Brothers Chairman and CEO, joins us exclusively. He's right next to me here at Post 9. But, Jim, I'm going to let you start this off with Mr. Yearley.
Okay, so, Doug, great to see you. Thank you for coming on.
My pleasure, Jim. Nice to see you.
All right, so, Doug, fastest increase in mortgage prices. I can't believe how much interest went up. Obviously, homes now over $1 million, and yet you had record numbers. Your gross margins are terrific. The consumer did not pull back. How is this possible?
Yeah, Jim, we've had 2 record years in a row now in the face of rates that have been 6 to 8%. 2 years ago, December of 21, we had a 3% mortgage rate, and 6 weeks ago, it broke through 8 to 8.25. Thankfully, in the last 6 weeks, we're back down to 7.25, so things are looking good. But the dynamics are really, really strong. Historically, about 10% of the homes in this country are sold as new homes, 90% are resales. But with the people that own a home locked into a 3 to 4% rate, the resale market is completely frozen. It's at historic tight low levels, and now 30% of the homes in this country that are sold are new. So there's a migration to new because we have the homes, they're energy efficient, the architecture's great, we can buy down mortgage rates, and so we're really benefiting. The old trade was when rates go up, sell the builders, and that has just not been the case. And so the industry has really benefited, and I'm really proud of where Toll Brothers is positioned.
Well, you should be. I think, I tell you, the thing I'm most impressed about, you gave a forecast that is good just by nature. 65% in backlog, you've got homes built to suit. And what is it, 26% paid all cash for a $1 million home?
Yeah, historically it's been 20% for us. Our buyers are more affluent because our average house is about $1 million. And right now it's jumped up to 26%. And those that get a mortgage, the loan-to-value ratio is 69%. They're putting 31% down and only mortgaging 69%. So our buyer is financially very sound. They're upwardly mobile. And even in the face of these higher rates, we have ourselves a really good market.
Well, I am blown away, and you mentioned something that's really important for the stock. Typically right now, the home builders would be the last stocks that you want to own. But I see a buyer that bought 18.9 million shares, spent $1.3 billion, put down, $400 million in debt that you bought back. Doug, this is the opposite of what I'm used to home builders seeing, which is, overdoing it, putting up too many houses, and then getting killed. This is I'm not saying Toll Brothers wasn't conservative. You always been great. But it's shocking how much you're buying back and how much you believe in your company.
Jim, I'll tell you, the industry has changed dramatically. The way these companies are now being run, we're so focused on returns. We are keeping land off our balance sheets. We're optioning land. We're returning cash to shareholders. Even with the run that Toll Brothers has had, we are trading at 7 times earnings, 1.3 times book. There's a runway out in front of us, and this whole industry, I said it yesterday on the call, I got on a soapbox for a minute. This industry really should be looked at hard for a re-rating because these companies are structurally run differently. And for us to have the business we're having in the face of these rates, I'm just super proud of not just Toll Brothers, but I'm super proud of how this group is now being run, and we just deserve more respect.
All right, so I'll ask that. Structurally run differently means what then?
So, number one is the capital efficiency. Historically, builders bought a lot of land. We loaded our balance sheet with land. We weren't as focused on whether we owned the land or we optioned it. And now you find these companies that, we have a couple of years supply of land that we own. The balance is optioned. So we're able to use more capital on more deals and have it all tied up in one deal, just on how we're structuring with land banking, joint ventures, getting option terms from our land sellers. And so that, I think, is the number one way it's changed. But fundamentally within the companies, the operations, how we're running, the SG&A leverage that we're seeing, the efficiency of these homes that we're building. There's just been a fundamental change in the last decade.
All right, so home sales gross margin was 27.5%. That's for the fourth quarter. I think full year was a bit below that. Is that sustainable, though, 27.5%?
It is. For a couple of quarters now, we're faced with some of the sales we had in the second half of 22 when the market was much slower and we had to incentivize a little bit more. So there'll be a very, very small dip for just a little window here as those homes deliver. But longer term, we think we're able to sustain margins in that range.
Jim's got a final question for you.
Doug, Denver, Boise, Southern California, Texas, Mid-Atlantic, Eastern Seaboard, these were all quoted as being hot. That's an incredible part of the country. It's huge.
Yeah, it really is, Jim. You know, everyone talked about the West through COVID. Our hottest corridor has been Atlanta up to Boston, the Eastern Seaboard. We're still doing really well in other areas, but it's nationwide. We're in 24 states, 60 markets, and there are very, very few that I am worried about.